Hello, this is Doug Gerlach from myICLUB.com. Welcome to our Investment Club webinar. Today is Tuesday, July 16th, 2024. And tonight our topic is digging into the myICLUB Portfolio Review Report. This is one of the more than 40 reports and graphs in the myICLUB toolset that will help you to manage your club's portfolio. So we're going to be digging into the details and give you a sense of what's going on with that report, how to interpret it, all the things that are going into it. So if you have questions, please feel free to use the questions box. You can type in your questions at any point, and the handout in PDF format for the presentation is also available there for you to download. Some of you may know that for the past 15 or 16 months, my partner in crime and I have been traveling the country on a full-time basis, and this has allowed me to visit a lot of the chapters around the country. So I've got a full schedule through the end of the year with a number of Better Investing chapters. I'll be presenting educational presentations during various workshops and events. Some of these are online as well. You can see the full details in the myICLUB calendar, but you can also see them with links to the registration offerings at the Small Cap Informer website in the resources section. There's an upcoming events calendar there that lists all of the activities that we have scheduled. And so if you're in any of these areas, I look forward to seeing you at these events. Tonight, we're going to be taking a look at this myICLUB portfolio review report and demonstrate how it can help you to identify company problems before too much damage is done to your stock's price. It will help you discern trends that suggest when it might be prudent to buy, sell, or hold a particular security. It will help you to make sure that you're meeting your portfolio objectives, and also help you to take action when fundamentals are weakening in your particular company. So let's start with some of the basics and getting acquainted with the myICLUB portfolio review report. Going back in time, the portfolio review report is actually part of a framework that Better Investing developed beginning in the 1950s to help investment clubs and individual investors to manage their portfolios and to identify stocks that fit a particular style of growth and value stock investing. So this report is designed to help you manage your portfolio if you're using the stock selection guide. And the factors that are used in this portfolio review report may not apply to stocks that are selected using other strategies. So if your club is not focused on the Better Investing style of stock analysis and portfolio management, then many of the attributes of the portfolio review report are not going to be as applicable to your particular situation. And now going back in time once again, if you recall in the 1950s, when there were no personal computers, the whole process of completing a stock selection guide required paper and pencil, rulers, colored pencils. It was very time-consuming. Data was not immediately accessible as it is now with a click of your mouse. And so the prospect of updating a stock selection guide on a even monthly or quarterly basis was pretty daunting. If you had a large portfolio, you didn't want to redo all of your stock selection guides. And so some of the portfolio management forms and systems that were developed at the time helped to track the most important elements of company fundamentals. Collectively, these became known as the Portfolio Evaluation Review Technique, or PERT. The PERT report, which is the original name of the Portfolio Review Report, part of one of my objectives has been to eliminate or de-emphasize the use of acronyms that don't tell you much about the underlying tools in the Better Investing toolset. So I refer to the PERT report as the Portfolio Review Report because it helps you to review your portfolio. There are also several other reports that derive from the PERT report in myICLUB that you will find in your reports section. The portfolio summary, the trend, the offense, and the defense. These are all derivative of the portfolio like the Portfolio Management Guide, also known as the Stock Management Guide, the PERT A report, which is also known as the Quarterly Trend Report, the PERT A graph, which is the Quarterly Trend Graph, and the PERT B report, which is the Annual PE Analysis Report. The some of the tools in SSG Plus have also migrated away from using some of the PERT nomenclature as well. They do refer to the PERT report, but the PERT A report is the Quarterly Trend Report, for instance. But we're all kind of referring to a same set of tools that are available to you. Now, the purpose of the PERT is to help you to monitor a portfolio and verify that your club stocks are meeting your expectations as they are set on the stock selection guide. Using that PERT form allows changes in the company's conditions, the fundamentals, that you can spot them and then track them over time. And once a trend develops, especially if it's a negative trend, you can decide to take action. It's simply put, it's good portfolio management. It helps you focus in on the most important elements of the companies that you own that you should be reviewing on a regular basis. I like to refer to it as an early warning system. Almost every time that there's trouble with a company, if you look back, you will find the signs that you could have seen if you had been watching. And the issue with the stock selection guide is that it's mostly all about the annual data. Sure, you can plot the quarters, the most recent quarters of earnings and pre-tax profits and revenues on the front of the graph, but the back doesn't give you a very good access to recent quarterly profit margin trends, doesn't give you a very clear unified perspective on the PE ratios of the month since the prior fiscal year end. So there are a lot of elements that you don't get to see when you look at an annual viewpoint that are really important once you are the owner of a particular company. So this key to portfolio management, regularly monitoring, is the objective of this PERT and portfolio review system. And we always recommend that at least review your holdings on a quarterly basis. In an investment club, that makes a whole lot of sense. You can cover each of the stocks you own just on a quarterly basis. You don't need to have the stock watcher report every month. Often there's nothing important enough that warrants spending the club's time on, but when there are problems, you want to have the ability to discuss, to research, to review, to make decisions about the stocks that you're owning. And that quarterly review, I'll talk about this a little bit later, is gives you plenty of time. You're never going to catch the stock that's suddenly revealed lots of bad news and the price is fallen in half. There's no way that we as individual investors can really protect against those types of fundamental and price-driven problems that you might experience. But we're talking about the slow downward drift that is almost undiscernible unless you're paying attention until one day the market wakes up and says, hey, this company really does look like it's having problems, and the massive sell-off occurs. So we want to be ahead of the herd in many respects, and so we can do that with a quarterly review pretty effectively. It's a very time-efficient way of addressing your portfolio. So you'll hear me talk about poor fundamentals. What do we mean by poor fundamentals? Well, often the drivers of company performance, price performance, are expectations, obviously what the market expects, what investors anticipate that how a company will perform. But Often when we see price drops, you see one of your stocks appears on the biggest losers list of the day, it's because something bad has happened or something bad is feared to happen by the market. Maybe the revenues and earnings aren't growing as expected when the company reports its quarterly results. Maybe there's some income statement or balance sheet items, or there's some other troubling news about the company or its management. And there could be external factors. Certainly news about the economy, whether it's positive or negative, can impact many different types of companies, especially cyclicals. Same with inflation statistics and interest rate moves. Frequently, it's easy to identify what caused a problem. Occasionally, it's not so obvious. You've got to dig a little deeper. Many of these bad events will push the price down, but maybe that's only temporary. And maybe the problems never actually come to fruition. It's just a caution of the market players that they don't want to be caught with their pants down, so to speak, and so they're going to get rid of the stock at the first whiff of bad news. It could be insignificant to the long-term prospects, or it may be the continuation of a trend. If you've been paying attention, that you'll now know this is several quarters where things are not quite as rosy as they were when you first purchased the company, and that could be a reason to sell. So most problems eventually will show up on the stock selection guide. If the revenues are falling on a quarterly basis, eventually that year might look a little depressed relative to the prior year. If the share price falls, the PE ratio might be adjusted disadvantageously to you. If the profit margins are declining, that'll show up in section 2B. But as I mentioned, that SSG is focused on those annual viewpoints. And so if you rely on the SSG, you're only going to be able to identify problems after the stock price has been well pushed down. So you need to monitor your holdings. That's the moral of the story. Before the problems get out of hand, you don't want to be caught napping with your portfolio. So this is the basic approach. Now let's turn now to the myICLUB portfolio review report as it's implemented in myICLUB. In the words of Ralph Seeger, who developed the PERT methodology, a longtime NAIC Better Investing trustee, founder of the Investor Advisory Service, he referred to the portfolio review report as an SSG without a graph for the entire portfolio. It shows you the changes in the quarterly and trailing 12-month sales, pre-tax profit earnings, and pre-tax profit margins as percentage of sales, so that you can identify if they're rising, if they're declining. Does the change, if they have gone up, are they going up as you expected on your stock selection guide? This report also shows the price and return metrics from the stock's current price, such as the current and future PEs, the relative value, the projected earnings growth, upside downside ratio, and the projected total return. Now, the advantage of having this all in the computer is the potential problem areas are highlighted. So that reduces the need for you to do careful line-by-line numerical analysis. You can focus on those highlighted areas. Now, the SSG Plus also has a PERT report that you can utilize in your individual account, and that PERT report and the portfolio review report on myICLUB are intended to show the same results in both places, assuming the same SSG inputs, but we can't necessarily guarantee that they're always going to be the same. We have discovered, and as we dig around, that one of them was flagging values at a slightly different range than the other, and we do work to unify those values. So the intention is that they are the same. Christina says, why should the club move to the myICLUB review report? I presume you feel your reports are better than PERT. No, the reports are the same. The advantage is that in SSG Plus, it's your individual portfolio. In myICLUB, it's the club's portfolio, where every stock watcher can manage their particular stock in SSG Plus, have it linked to the club's portfolio, so the club can see on its private club website the results of all of the stock watchers who have updated their SSGs, and then manages the results that way. So you're certainly free to use the SSG Plus. I have no problem with using SSG Plus for your personal portfolio. We believe that a distributed workflow works best in an investment club where everyone gets to contribute and can monitor stocks. The only way to monitor your club's stocks in SSG Plus is if one member is doing all the SSGs or is importing all of the shared SSGs from the club members. And you've just created a lot of work that's really unnecessary because the reports are essentially identical. I'll point out that there are help pages and documents for the SSG Plus PERT report and other portfolio tools that can be a good reference. On the myICLUB side, our help documents will give you the basics without digging into the methodology. The methodology belongs to Better Investing, so their tools will give you a little more explanation. But if you understand the PERT report, in SSG Plus on the Better Investing website, then you'll have no trouble with the portfolio review report on myICLUB. Now, also the myICLUB report will only show, and this is the same for SSG Plus, publicly traded North American common stocks on the report, operating companies. On myICLUB, we use the quote system in your club security settings for all of the stocks and other securities that you own. We do include REITs. And by the way, for the last couple of weeks, real estate investment trust data in both the Better Investing and the ICLUBcentral myICLUB tools are all using funds from operations in place of earnings per share. So now you can complete an analysis of a REIT using those tools. We don't recommend REITs for investment clubs, remember that, but that REIT data is now available, so it makes it useful if you are holding a REIT, aware of the problems that they cause at tax time. ADRs, American Depository Receipts, are also included. Publicly traded partnerships are included. But if it's a stock that sells on the pink sheets, these are the micro cap stocks, over-the-counter stocks, often most of those are not included in our fundamental data feed. ETFs, mutual funds, private securities, or non-US stocks trading on non-US exchanges will not have data available in the portfolio review report. So it really is focused purely on stocks. It's not meant to cover ETFs and mutual funds and other types of securities. So this is another distinction of this particular report. Now, the portfolio review report includes what we refer to as judgment data. Judgment data is based on the stock selection guide elements that the user sets, such as earnings growth rates or sales growth rates, selected high and low PE ratios, selected high and low prices. These are all subject to the individual's analysis. And so the report shows the results based on that judgment. So in myICLUB, if the stock has a linked SSG prepared by the club stock watcher, in other words, the stock has been assigned to a club member, that member has completed a stock selection guide and updates it regularly in SSG Plus, and that study is linked to the club's portfolio, then we use the data and the price return values from that SSG. Now, this is important no matter how old they are. So this is why it's important that your members update their stock selection guides prior to a meeting if you're using the linked system. And the reason we don't show the price from the valuation for those linked studies is because all the other metrics might be thrown off. If we're using a price from one date, then the PE ratio that we're showing is not going to be accurate. So we've made the decision that we believe it's important enough that members prepare an updated stock selection guide prior to each meeting so that it will feed into this report and provide accurate results. So if the stock has no linked SSG, then on the fundamental data side, we'll display the facts, the data. the percentage change. Those aren't subject to interpretation or judgment. On the price side and the return side, we don't know your judgment, so we show not NA, not available for all of those values. So to reiterate, it's really useful, most useful when members are maintaining updated stock selection guides. So it's important to get them into the routine. If you're the president or the secretary and you're communicating with members when you send out the agenda, a gentle reminder to update your stock selection guide prior to the meeting is really useful to the club's portfolio management tasks. And to that end, on the report, we will show when it was last updated and who each stock has been assigned to. So the idea is to keep everyone culpable, responsible for their contributions to the club. Now, also point out the little 4-letter word at the top right of the myICLUB menu that says help. This is where you can click for more information about the report and complete definitions of the columns there. So feel free to click that if you have questions before you reach out to us. Also point out that our user guide has several pages that describe the report and how to use it. It describes how to link your SSG stock studies from SSG Plus and all of the other aspects of the site. We will be doing a little update of the manual later this year as we roll out some new features and functionality, but you can always download the most recent version from the help section of myICLUB. Now, in just a minute, I'm going to show you the report, but there are there's a distinction between the SSG Plus version. We show on myICLUB a default version that's in an abbreviated format. We've taken out some of the fields and some of the underlying data used in calculations. This makes it, I think, much easier to interpret than the full version, but you can always look at the full version of the report by clicking Show Extended Report at the very top of it. Remember, this was a paper form. So it used to be that the idea was the investor or the investment club portfolio manager would fill in all of these values by hand, do the calculations, put those calculations in, and so you would have the underlying data, the quarterly results, the quarterly revenue fields for this year and the year ago quarter. You'd calculate the percentage change, you'd write that in, and so on and so forth. My feeling is that in the computer era, you don't need to see the underlying data. If we can show you the percentage change, for instance, that should be enough in this particular report to help you to understand how your companies are performing. So this is the default report view on myICLUB. Also note that you can move your mouse over the column headers for definitions there. And we've tried to keep it as simple and straightforward as possible. So there are abbreviations to keep it the columns as narrow as possible. But you can see on the left side, the ticker is there. The company name has been taken off for space purposes. The stock watcher is there. The date of the last time they updated their stock study is also there. And then you will see some highlighting, and we'll go over that highlighting. You'll see here the example of Earl has not linked. He's the stock watcher for Air Lease. On the second line, he's not done an SSG that's linked to the club's portfolio. So on the right side, you'll see all the NAs that fill in the quarter, and the price comes from the most recent valuation. The extended report view has the full range of all of the data, so it gets a little cramped, it gets a little more complicated to view, but you still see the shading, you still see all of the information and the additional data that's there as well. So here are the key things that are different in the extended report. On the left side, you'll see those first 1, 2, 3, 4, 5, 6, 7, 6 or 7 columns, cells where they've got the quarter end. For the first one, Apple, quarter ending March 2024 compared to the quarter ending March 2023. So you've got the earnings, in this case, the earnings for this year and the year ago quarter. We do the same thing for the sales. We do the same thing for the pre-tax profit. We do the same thing for the trailing 12-month earnings. And so we're showing those underlying values. So I think that makes it a little cluttered. If we tell you that the percentage change was 0.7%, you don't need to see the underlying values. That's the thought. On the right side, we show in the extended report the 5-year average PE ratios from your stock selection guide, the high, average, and low PE ratios, your projections. And again, we don't show those in the default report because they're incorporated into the projected PE and projected relative value figures. So we don't feel like you need to see those perhaps. On the far right, the 5-year estimated high and low prices, we also don't show those. There are other reports that will show you if a stock is in the buy zone, but that's not the purpose of this report. We're looking at the fundamentals here. So let's take a look at those fundamentals. On the left side is where the fundamentals are, the matters of fact, as I refer to them. This is just data. A quarter was reported. There's a percentage change for earnings, for sales, for pre-tax profit. There's a profit margin. That's the pre-tax profit as a percentage of sales column. And we also look at the trailing 12-month earnings per share percentage change. Instead of just looking at this quarter compared to the year ago quarter, we look at the last 12 months compared to the 12 months before then. That gives you a little better sense of the existence of a trend, perhaps. So in this case, for Apple, in this example, you'll see that the earnings were flat quarter over quarter on a trailing 12-month basis. However, they were down 4.4%. So for some companies, you might say, well, gosh, they've improved a little in the most recent quarter because they've gone up to zero from below zero. So we can do a little interpretation and get at least a glancing understanding of the company fundamentals. On the right side, we look at the price and return metrics, the projected PE ratio. So in other words, the current earnings or current price divided by projected earnings for the company, the current price. And you'll see the dates there in red if they are stale, or in black if they're current. The projected relative value, or estimated earnings per share growth, the PEG ratio, the reward to risk ratio, and the percentage total return. And so those values, some of those values are highlighted. These are all matters of judgment. So every investor might have a different opinion about growth rates and where the buy zone is, what the high and low expected future prices are. And so these are the values that we don't show if there is no stock selection guide. So let's start with the left side fundamentals. Anytime you see pink shading, that's indication there may be trouble. These are certainly companies that you want to keep on your radar screen, so to speak. There won't be any shading for companies that don't have a linked stock selection guide. So the Air Lease in the second line, there are negative values there. They're not shaded because there's no SSG to compare the data to. And so again, while this is a slice in time, it's telling you that as of this quarter, there are certain factors here for these companies that you need to pay attention to, that you need to understand. So the way that a value gets shaded in pink is if the actual results are less than the projected growth rate on the stock watcher's SSG, right? So the thinking is, if we go back here and say, well, gosh, I projected Apple to grow earnings at 8% a year, and in the most recent quarter, earnings only grew 0.7%. That's important information. It may be explainable, it may be justifiable, it may be a one-time occurrence, but it's also undeniable that if Apple continues to deliver earnings growth at 0.7% for the next 3 quarters or 4 quarters, that your 8% growth expectation is not going to be met. Right? That's the bottom line. So that's what this report is trying to tell you, pointing out where that some of your stock selection guides may be overly optimistic
or the company may be having problems. Now, I will point out that we have on this report projected pre-tax profit growth, and we flag it. You can see the pre-tax profit columns there. The percentage change is flagged, and that's because we're comparing pre-tax profit growth to earnings per share growth, because they should track over time. And the only reason they wouldn't is if the company is buying back shares, for instance, or issuing more shares. But if they're buying back shares, the number of shares outstanding goes down, earnings per share goes up. And so the most conservative approach is that pre-tax profit and earnings per share growth should track pretty closely over time. And we'll talk more about that as well. So if in any of these values, you should be aware that the company is not living up to your expectations on the stock selection guide. What you're going to do about that, we'll talk about that in a minute. Companies can slip. Any company can slip up for a quarter or 2 quarters or even 3 quarters. There are all sorts of circumstances for which companies do occasionally underperform expectations. Your stock watcher should be able to explain why. It shouldn't be a mystery. It should be information that's conveyed to the rest of the club members. You can find out from company reports by reading the transcripts of their most recent earnings conference call. You can look at other news articles that you find on the internet and understand exactly what happened that caused this company to come in below your expectations. Now, there's one theory that you might be aware of is what's known as the cockroach theory, which is to say that if you walk into your kitchen late at night and you turn on the light and you see a cockroach, you likely do not have a one cockroach problem. And the same is true with publicly traded companies. When they report a problem, a lot of the investing community says, well, that seems pretty minor, but companies that have minor problems that are visible often have major problems that we can't see. And so they may sell off the shares, again, trying to be cautious. It could be a buying opportunity if you understand the cause of the problem that the company has revealed, and you might say, well, this is a temporary issue, and so it should be a good opportunity for us to buy more shares. However, in any case, you want to be watching the fundamentals pretty closely, and because if they continue on that downtrend, then we're going to be dealing with those devastating price declines that we're trying to avoid. So as I mentioned, problems with earnings per share falloffs can be masked. And if you're not paying attention and you don't know that the company is buying back all of these shares, this has boosted their earnings per share growth or mitigated the decline that comes from the fundamental problems. Often you'll see companies using share buybacks as crisis management. They know things are bad, so they use their cash. They might borrow money to buy shares, which then maintains earnings per share, or at least doesn't cause the drop-offs to be so significant. They may make earnings adjustments, so you might be looking at adjusted earnings. And so, again, often you have to pay attention. What are the adjustments that they're making? Are they valid? Is this something that is hiding permanent problems, or is this just a reflection of some changes in business strategy or divestiture of money-losing businesses or something like that? Changes in tax rate. There were a lot of companies in 2017 that all of a sudden had big jumps in profit because of the cut in the corporate tax rates. So often those companies might have been struggling a little with their earnings, but they were able to post really positive results, and everyone's happy, not realizing that fundamentally nothing has changed. So we look at pre-tax profits because they're not nearly as easily manipulated. And so if you're going to do anything at all, you should be paying attention to those pre-tax profit trends. How much are the pre-tax profits growing or shrinking over time? and that will enable you to get a better handle on the particulars that companies might be experiencing. In SSG Plus, you can use the quarterly growth trend graph for stocks that you are concerned about. And again, focus on the pre-tax, the change in pre-tax profit on a quarter-to-quarter or trailing 12-month basis, and see if you can identify a trend up, down, sideways, erratic, and that can help you understand what's going on with the company. Now, we keep talking about trends because we are focused on the long term. We do acknowledge that no company is perfect and may not always deliver the best results quarter after quarter. Often the companies that do post those types of stellar results on an ongoing basis run into problems because they can't do it indefinitely. And when the growth starts to slip, then the market players who are chasing after them from a momentum play are now dumping them. So we're going to focus on trends. 1 or 2 quarters is not a trend, but after 3 quarters, then we really want to make sure that we understand what's going on with the company and why things are changing. When you're looking at trends, you want to consider industry cycles. For instance, semiconductors and semiconductor equipment stocks tend to run on their own cycles that are independent of the economy. It takes a lot of capital to ramp up new generations of semiconductor chips, and the old chips lose their value even though they might be still being made because other competitors are delivering products that are equal to or better than those older chips. They become more value-based, and so they run in cycles that you can see when you look at the quarterly history of those particular companies. Seasonality is also something. Retail stocks famously always have big fourth quarters, and the second quarter for many retail companies might be pretty low, or the third quarter. They might typically have one quarter where revenues and earnings tend to fall off. So you want to understand that, and it's not necessarily a negative, but you want to be able to do the analysis. Trends never predict the future, and to keep in mind that the bigger the boat, the harder it is for it to change course. So when you do have big companies, especially on particular ongoing trends where it's getting harder and harder for them to make money, it becomes less likely that they're going to be able to turn things around, and they might have to take some pretty severe action to sell off some divisions or reorganize their company in order to get back into growth trend. And when you're looking at quarterly trends, the greater the number of quarters that especially pre-tax profit is affected, the greater the chance that there's some sort of long-term shift in place. There are a lot of well-managed companies out there that are simply so big that they don't fit into a growth investing model anymore, and that's the price of success. You can, there are also some, multi-trillion-dollar market cap companies now that are very large and are still expected to grow still huger over time. So keep that in mind, and every company is its own particular circumstance that you need to evaluate. I'll also point out something that people tend to forget is that recovery of a stock that's not performing well, recovery for a company whose profits and earnings are falling off, can often take much longer than you would hope. It's not something that they're going to turn on a dime and all of a sudden deliver one positive quarter of earnings growth after 5 quarters of earnings slowing and finally going negative. 1 quarter is not going to cut it in the market. Investors are not going to jump back on ship with this particular company just because of 1 quarter. It might take several years, and it might take several more quarters and several more years for the company to deliver results before the market finally forgets how bad they were stung when the company began to, the company's ship began to take on water. So I like to refer to pre-tax profit trends as an early warning system. Pre-tax profit, as I mentioned, should grow about the same rate as earnings. If it grows slower than earnings, or the pre-tax profit growth rate is declining, and you see this on the report, then it might also be that you've been too aggressive in your stock selection guide and you've selected earnings growth rate that is too high or that's unsustainable. So you might want to revisit your stock selection guide, look at analyst estimates, take a look at recent trends, and then figure out what the most likely conservative growth of earnings should be. There could be something negatively affecting the company's profitability. It should go without saying, but I'll say it because a lot of investment clubs that I come across seem to ignore the fact that growth below 0% is always troublesome. It's not growth. That's shrinking. We don't buy shrinking companies. We want to buy growing businesses. So anytime companies are delivering growth rates below 0, we want to pay attention very closely to those businesses. So to help you with the analysis part, for those pink shaded companies, here are 5 questions to ask. 1, why are the sales, pre-tax profit earnings not growing as well as you would expect? This takes investigation and some thought on your part to understand the reasons why. I find that the company's press release, for some companies, they can be very lucid and easy to read and will give you the story up front. Other companies, the press release is all bright, shiny, it's all good news. Even the bad news is good news. For both companies, I also like to look at the conference call or earnings call transcripts. You can often find those on Yahoo or Seeking Alpha, and those will give you more of a detail, and you'll also see where Wall Street analysts are asking questions. And if a company doesn't address a key issue, it's going to be brought up in the Q&A section, and that can be very interesting to hear how company responds to it. So what does management say? If it makes sense, it's okay to give them some slack. The corollary to the cockroach theory is the iceberg theory, that if we see the tip of an iceberg, chances are the bulk of the iceberg is below the water line, and we don't see it. So whenever we see the tip of an iceberg, if you're sailing in Arctic seas, you want to steer very clear of that particular iceberg. So the same is true with companies. Oftentimes, that small problem is the start of something big or is masking larger concerns. Give some thought to whether the problem is temporary or permanent. There are often temporary problems, and we shouldn't penalize companies too frequently for it. Most company management would much rather manage their business on a basis where they don't have to report 4 times a year to shareholders. Because if you're a management team and you're trying to build a business and you're trying to make investments to grow the business and you're trying to figure out how to allocate your resources best to grow the business, there might be some quarters where things work out better than other quarters, where investments are made, where investments are not made. If you have to focus on every single quarter delivering good news, it takes away from your ability to build the business over the long term. But when you come across problems, it can be useful, especially in a club framework, to set a deadline. How many quarters are you going to give the company from this company, this point in time going forward before you take action? And many years ago, I did talk with Ralph Seeger about this very issue and asked him, how many quarters do we wait? And the folks at the analysts at the Investor Advisory Service, they have a similar framework that after 3 consecutive quarters of problems, you should be getting ready to take action. And after the 5th quarter comes in with no resolution or continuing downtrends, then it's time to make a change. It's time to find a replacement. So I'll talk about some more strategies that you can implement using those. Number 5, can you find a replacement? You can always find a replacement for the underperforming stocks in your portfolio. Doesn't matter whether the market is up or down, whether we're in a recession or expansion of the economy. There are always good quality companies out there that will fit the hole in your portfolio left by a company that you have to eliminate because of underperformance on a fundamental side. So this, I call this an early warning system because if you think through what's going on here is the company missteps, right? They mess up, they have a bad quarter. The market penalizes them right away. Price goes down. There's a lot of negative chatter about the particular company. The stock will drift along at that new lower price point, probably for some point of time. There are a whole lot of people in the market who are ambivalent to fundamentals. Hopefully it's not you and your investment club. And it'll drift along for several quarters until one of two things happen. The company improves or it gets worse, right? And so during this period of drift is when savvy investors can pay attention and see those downtrends and take the time to do the analysis and extricate themselves before the rest of the market notices that things are not what they seem. Now, in some cases, companies reverse trends. It happens. But keep in mind that it's always better to have a portfolio of stocks that are not constantly posting, having troubles, having issues, having to resolve changes, having temporary problems. If you have companies that are more consistent over time, and again, that's the objective. It's not always possible, but think about the amount of discussion that your club has when stocks are underperforming on a fundamental basis, and think if we could just eliminate that company with a better performing business, we'd save everyone a half an hour a month of conversation and argument and discussion about what to do with this particular company. And that's a trade-off I think a lot of people would willingly make if they just sat back and thought about it logically and not emotionally. And then once you've made that decision, don't look back. If you sell or replace a stock, move on from it. It doesn't do you any good to go, well, we should have. Oh, well, we only had. Hindsight is always going to be better. But in the moment, all you can do is take action when action is needed. So after those are my thoughts on the fundamental process, we're going to turn to the right side, which is the value and return metrics, right? So the yellow highlighting gives us areas of possible concern. So the yellow items are flagged if the upside downside ratio is less than 1-to-1, if the projected relative value is greater than 150% or less than 80%, or if the projected total return is below 10%. I'll talk about those in a little more detail, but I want to remind you that stocks may be overvalued for one of two reasons. One, because they're successful, right? The price has gone up, and so maybe the relative value, which is the relationship of the current PE to the historical or projected PE, it gets much higher. Or they may be overvalued because of their failures. The price has fallen, the return potential is no longer there. So that right side of the report really is focused on those valuation metrics. Now, the upside downside ratio, the rule of thumb, of course, on the stock selection guide is we buy when the upside downside is 3-to-1 or better. And we refer to this as reward to risk as well. So another name for the same concept. 1-to-1, this means you have the same amount of upside from the current price as the downside. If it's much below that, if you have more downside to upside, well, then that's the wrong equation for the levels of risk and return in your portfolio. The projected relative value is the relationship between the current PE ratio and the historic PE ratio. So if they're the same, if the relative value is 100%, that means the current PE ratio is exactly the same as the average PE ratio of the last 5 years. On portfolio tools, we switch from using relative value, looking at the historical average PE to projected relative value, which uses your projected high and low PEs of the next 5 years. The reason for that is that this way we can incorporate changes in a company's condition. For instance, often we're taught to never use high PEs at the high end of the last 5 years. We want to reduce them a little bit and have a lower expectation of a high PE in the future. The same thing on the low PE side. So the projected relative value compares the current PE to the projected PE as it's calculated using your future high and low PE ratios that you set in the stock selection guide. So at 150%, this is a 1.5 times markup, if you will, to the current PE ratio. And whenever stocks get up into that on a projected RV basis to 150%, they are really at the peak of their price power. It's highly unlikely that they will be able to sustain that without some kind of heavy-duty miraculous earnings growth to justify that level of valuation. It's like going into a car dealer and looking at the manufacturer's suggested retail price and offering 1.5 times that for that particular vehicle. Now, the auto salesmen are going to be very happy to take that offer. They're selling something for much higher than the average price. Sometimes the particular car models might be very exclusive and hard to get, and so there will be times where car buyers will come in and offer more or than the manufacturer's suggested price. But for stocks, that's not a recipe for success. And for stocks that you own, it's often the case that those stocks are the ones that will do the most damage as their prices decline just from natural attrition. Now, below 80% projected relative value becomes less of an indicator, loses value, because a good business never sells for much more than 20 or 25% off its regular average quote unquote selling price, or the average PE. So below 80%, we're flagging that value as well, because that's telling us something is wrong, that the rest of the market is now deep discounting this stock. And that's not good for our portfolios. It might be good for buying, but there's a lot of risk in buying those stocks that have been discounted so well. The market knows something or thinks something or believes something. We need to understand it. And the projected total return below 10% is simply saying that if you want to build a portfolio that over time will outperform the market, if you load up on stocks that have total returns below 10%, it's unlikely that your portfolio will outperform the broader market. So, and especially as your projected total return gets close to 5 or 6% right now, you could be earning money in CDs, at that 5% rate, perhaps, without much risk to it. Whereas in the market, earning 5% return, there is the potential of you losing quite a lot of money, the nature of investing in equities. So projected total return below 10% is also another flag. So those are the rationale for those three flags highlighting on the portfolio review report. Now, I also subscribe to a 4 strikes you're out philosophy that I learned 20 years ago from a better investing volunteer in Philadelphia named Joe Smith. And his approach was that if you've got a stock where those 3 criteria are all met and the stock is in the sell zone, these are the strongest candidates for replacement. And his belief was that those stocks that have a limited upside threaten your total return potentials. They might be the biggest and best performers in your portfolio, but looking ahead, they're not going to be delivering as much return. And so the market might love these stocks. The market loves success stories, right? And so they'll carry them along at these excessively high valuations for some time. But they have to be handled with care in your portfolio because of the prospects of a sudden shift in the wins, which drives the prices down. We could, famously referred to as irrational exuberance. Those underperformers in your portfolio might appear to be good values, the stocks that have those low PE ratios, but if they're experiencing fundamentals, that can quickly turn those bargain stocks into out of business stocks, and so we want to watch out for that. On those high PE levels, again, I call those stocks hyper valued. They're not just overvalued. It's good to have overvalued stocks. I wish all of your portfolios were of all the stocks that you own right now become overvalued, and you just sit on them and reap the rewards from having an overvalued portfolio. We buy stocks when they're undervalued. We hope they become overvalued, and we hope they remain that way for a very long time. But hypervalued stocks, the stocks at the very upper echelons of the typical valuation range, those are dangerous, and those where action is often required. So we say action, what do I mean? Well, the portfolio review report doesn't tell you where a stock is going. It's an aid to judgment. It's not a replacement. None of the better investing tools replace common sense, replace your own opinions and analysis. It's meant to be a framework to help you make decisions and quantify potential results. If you monitor companies regularly, you can spot troubles earlier and take action before greater damage is done. It's like a weather report. The weather reports are often wrong. They predict a storm that never materialized, but it's always better to be prepared rather than to be surprised, right? And the risk is, of course, that people become inured to weather reports predicting big hurricanes and big storms because we've seen so many of them. They say, it'll pass. And then when it wipes out their house because they didn't take action, or they lost family and friends because they didn't evacuate. So we want to be prepared. We want to have and not be surprised by the bad news. Company problems. 3 categories, right? Temporary problems that resolve quickly, temporary problems that turn into permanent problems, and permanent long-term problems. Of the 3, I suggest that you try to find stocks that only have temporary problems that resolve quickly, right? And if you could do that, no problem. But that's not always so easily done. Stocks with high levels of uncertainty, I suggest you put them on probation in your portfolio, right? So stocks that have those recurring trends of declines in earnings and pre-tax profit, those become your probationary stocks. It means we're not going to buy any more of them until we are certain things are ironed out. We're not necessarily going to sell those stocks until we have found replacements, until we understand what's going on. Buy and hold investing often gets a bad rap in the media, who refer to it disparagingly as buy and forget investing. And it's never buy and forget. Fundamental problems should always be addressed before you deal with the valuation side. But you're radar operator, right? You're constantly scanning the portfolio for signs of real fundamental trouble. Ralph Seeger, who I mentioned before, liked to say that remind people that a torpedo could come out of the dark at any time. He was, lived through World War II and understood the dangers of a ship on the high seas that had to be constantly vigilant and watch out for those torpedoes streaming towards them. And his suggestion was that you consider your portfolio the same way. You want to watch out for potential problems, be aware of them, be able to take defensive action. You don't have to take knee-jerk reactions to negative conditions, but you want to understand them and be ready to take them. And you might be occasionally wrong, right? There's no, Will Rogers said the best way to buy stocks is to only buy stocks if they go up, and if they don't go up, don't buy them. You're never going to be completely correct in all of your calls, but if you are uncertain about your company, replacing it may be a better idea than you want to admit. I have a big beef with clubs who hold stocks and investors who hold stocks that are not performing well, and when you talk about them, they say, I just don't know what to do. if you don't know what to do, you're doing something. You're holding. You're ignoring the problem, perhaps. And I don't believe that you should hold uncertainty in your portfolio. When you bought the stock, you never said, "Well, I'm not so. I don't know. It might not be a good idea. Let's buy 10,000 shares." No, you were confident. You were relatively confident in the decision. If you've lost that confidence in the company, ask yourself, are there other companies out there that we could be more confident in? Your logic and experience will help you to evaluate the opportunities that are available and to take action. One of my other strategies is, if you're unsure about a company, to label a stock in question available for cash, AFC. That's my nomenclature. It simply means that you've decided this stock probably doesn't fit in the portfolio anymore, and you are in search of replacements. And that gives you time over a couple of meetings to find replacement candidates. And if the company recovers before you found a replacement, great. You might put it on a new track and say, all right, we're going to continue to hold this stock now and not replace it. At this point in time, you'll be able to do the comparison guide between the companies. You'll be able to challenge them and figure out maybe it would be a good time, since you've recovered a little bit of your losses, maybe it's time to replace that particular company. And if the company doesn't come back, well, will have found some compelling candidates that will give you a rationale to replace those underperformers. From a cognitive bias basis, you're going to be able to mitigate the pain of selling at a loss with the excitement of a shiny new stock that you can add to your portfolio. So those are my thoughts on the portfolio review report and the intention of it. I'm going to take a look at the questions now and see what we can do. As always, my email is there if you have questions or comments. I see that Gary comments that it's difficult to match the column title to the corresponding columns. Yeah, it's difficult because every browser renders the table differently of the portfolio review report, and there's so much going on. We try to keep it compact, but sometimes things wrap in different ways. Sometimes numbers are bigger than we expect, and so there are all sorts of issues around the formatting. We have a project going on right now to revamp, hopefully revamp some of the forms and the formatting to make them a little clearer. So I accept that criticism. I'm aware of it. We've gone through many iterations of trying to come up with better things. I think it's better than it has been in the past. Christina says, what do we expect what would you consider to be the best 3 to 4 portfolio reports to present during a club meeting for time's sake to best represent the portfolio's direction? That's a great report. I know that some clubs, Russell frequently talks about showing the portfolio diversification graphs, the sector, industry, and company size graphs at club meetings. Those are real easy reports. They're graphs, they're pie charts. So they're really easy to interpret, to understand, and to give the club a sense of, gosh, we are really overweighted in technology, or boy, we really could use some more small company stocks. And so it gives you an instant sense of what needs to be done to fit the model. The portfolio summary report is a great, very straightforward report that doesn't overwhelm you. And that report will tell you, well, here are the stocks that are in the buy zone. So if you had capital to deploy, you could go to that report very quickly and say, oh, okay, we're underweight in this stock relative to our target, and it is in the buy zone. So why don't we deploy some capital to make that purchase this month? So the portfolio report, the trend report is sort of a subset. The portfolio trend report is sort of a subset of the portfolio review report. So I think between the trend, the summary, and the size and sector industry graphs, those are probably a good set. And then you might make a plan that every other meeting you look at some other element of the club portfolio, or you set aside a couple of months where 4 times a year where you're going to look at the fundamentals on the review report and really dig in and look at the trends. That would be my suggestion on how you figure it out. Let's see here. Russell's been in the back office tonight helping out. Sean is on vacation, so he's missing out on all the fun tonight that we usually exist. But Russell's been doing a great job in the back office. Diane says, once you own a stock, how often should you update the stock selection guide? Again, the using SSG Plus today, you can update your stocks once a month. Or if you like looking once a week, it's not necessary. Once a quarter is the minimum. I would say review the stock selection guide at least on a quarterly basis. And because it doesn't take very long using SSG Plus, once you own a stock, once you've bought it, you understand it a little bit, updating the stock selection guide, reviewing the quarterly results, is not something that's going to take lots and lots of time. So it's something you can do pretty quickly, pretty easily. I suggest sitting down, maybe once a month and just going through the news reports for the companies that you own and updating your studies that way. People who do it once a week, again, there are a lot of spouses of retired couples who are happy that their husbands are spending time updating their stock selection guides on a daily or weekly basis. Keeps them out of trouble. They're researching the portfolio. They're trying to be useful, but it's not needed. Once a quarter is a good target. We talk about if your club is going to do a portfolio review segment at each meeting, then everybody needs to update the price and any fundamental changes that have happened, refresh the data in their stock studies prior to the meeting. Strictly speaking, because every stock is on a different reporting schedule, we can't say just do it, in middle of April to catch the companies that report on March 30th, because some companies will not have reported. They're on a different calendar schedule. So that's the finessing of it that you need to kind of figure out on your own, and what works best for your particular club.
Doug?
Yes,
I just
Russell.
wanted to add just about making a new one also. I just want to remind people, if you make a new one on the BI site, it won't be linked to your myICLUB. You have to link the new one to the myICLUB. While updating it and even changing the judgment, you will keep the link. So yep. Be aware of that.
Yeah, absolutely. Thank you, Russell. That is absolutely something that we've run into, where people come back to SSG Plus and they create a new stock study for their tracked stock. Last month, Sean, during our club webinar, presented some tips on using the linked SSG function of myICLUB and SSG Plus. My tip is, in the stock study title, put the name of your club in parentheses after the name of the company, and that way you know if you've got multiple studies. And to Diane's point, maybe a lot of people like to save the study that they created and base their buy decision on, right? They use that study. And they save it, and some in parentheses after what might say original or buy, and then lock it and never update it. And that way, 3 years later, you can go back and look at it and go, when everyone's saying, when you're saying to yourself, what was I thinking when I bought this stock? You can go back to the SSG, open it, and go, oh, that's what I was thinking. Well, it didn't really work out. Maybe that's more fuel for the decision to replace that particular holding. But yeah, keep in mind that if you change create a new study in SSG Plus, if it's linked to your club portfolio, you need to update it. I also suggest that if you are following a stock that you own personally, that you maintain 2 separate SSGs. Maybe your club has a different approach than you do personally. Maybe you're a little more aggressive, they're a little more conservative. So break them up that way. And again, you can use the name field, the company name field, to differentiate them between what you differentiate between the two. All right, with that, I want to thank you for coming to our presentation tonight on the portfolio review report. Hopefully it's been helpful to you. As always, you can reach out to us with your questions. We'll look forward to seeing you at our August Investment Club webinar. Our full schedule is on the myICLUB website, so you can find the topics for the rest of the year there. As always, we're always interested in hearing what you would like us to see, what topics you'd like us to address. And I hope you're all staying cool this hot summer. We'll look forward to seeing you next month.